What is happening, traders? Thanks for tuning in.
It is Thursday, April 15th, and we are coming to you from Los Angeles, California.
This is Andrew.
And I'm Jason.
And we are Let's Talk Trades. I got one question for you and one question for you only. Did you buy that Coinbase IPO today?
Ha! Nah. IPOs are not the business. I'm not an IPOer.
Yeah, same. I mean, maybe if they went public through a SPAC, I probably would have jumped in. And we got two hot stories for you today, traders.
We're going to break down what an IPO is, why it's bullshit, and some alternatives to an IPO, and why SPACs might not be so bad after all.
And for our second heater, we will be following the money and the infrastructure bill.
Let's hop right into this.
All right, traders. So as we said, Coinbase IPO'd earlier, and they went public through a direct listing, not an IPO. Their stock price was listed at $250 per share, giving them a valuation of $65 billion, which means it's not just a one unicorn, it's actually a pack of unicorns.
A direct listing or direct public offering, DPO, whatever you want to call it, is when a company goes public without the assistance of any bank, unlike an IPO.
An initial public offering, or IPO, refers to the most common way a private company usually goes public. The company will partner with the bank, and the bank will assist the entire process of going public.
And this, my friends, is where the bullshit begins. IPOs consist of three parts. The first is the pre-marketing phase, where they let big banks know they are interested in going public, and then proceed to listen to the bank's offers of their services. The second phase is when they go public and their stock is tradable on exchanges. The third part is the same no matter how you go public, and that is you have to execute.
It's time for the company to sink or swim, feast or famine, whatever you want to say.
These big banks are known as underwriters such as JP Morgan or Goldman Sachs.
The underwriters, or banks, lead this entire IPO process, and they are chosen by the company. So banks will usually compete for this privilege since they are bound to make a solid profit from the transaction.
While a company does get to choose its own underwriter, the banks have to be involved in every aspect of the IPO process, whether it is document preparation, filing, marketing, or stock issuance.
And part of the bank's job is to set the share price, since they have assumed a lot of the risk and have complete control of the IPO process.
So basically, a private company selects a bank to guide them through the process of going public?
Yep, the banks do a lot of the work and all the heavy lifting, and that's why they make a lot of money when the company IPOs. And as we mentioned earlier, companies have alternatives to IPOs or DPOs when they decide to go public.
SPACs have become a more enticing way for smaller retail investors like us to get in on the ground level.
And now we covered SPACs in an early episode titled SPAC Me Baby One More Time.
Check it out if you want to hear more about SPACs.
So like you said earlier, SPACs are easier to get into at the ground level when compared to IPOs. This is because banks control the share price in IPOs, and the banks could run that price up before retail investors can even get an order in, making some IPOs feel out of reach for the average investor by the time the market opens. Airbnb was set to IPO at $68, but when the market finally opened and retail investors were ready to buy some stocks, Airbnb stock had already soared 117%. eToro, which is a cryptocurrency platform somewhat similar to Coinbase, is also going public through a SPAC right now, which was priced about $10 before the news broke, just like the majority of SPACs on the market pre-merger.
Okay, so Coinbase was supposed to be listed at $250 a share. Came out at $379. I can buy almost 38 shares of a SPAC for that one share of Coinbase.
That's shady.
Right, my $10 SPAC has a better chance of doubling than a $250 IPO, simply because valuations can rise much quicker at smaller valuations, especially for a rising tech company.
When the news came out that eToro was merging with the SPAC, fintech acquisition company, their stock jumped 50%, and all the retail investors that had bought that SPAC pre-merger just because they believed in the board of directors got to ride that rocket up. And now talking just from a risk-reward perspective, a SPAC like eToro is more appealing than Coinbase. I could double, maybe even quadruple my returns by getting into a SPAC pre-merger, which really gives me ground level prices and makes me feel like a venture capitalist.
Well, I mean, that's exactly what you kind of have to be. in order to get in on these ground level prices of these unicorn companies. Coinbase even did a DPO, which means that banks didn't touch their stock till pre-market Wednesday. And in a few seconds, their share price was over $400. It was crazy. And guess what? 10 minutes later, the share price was 15% below opening. I saw ask orders already placed for well above $400, meaning the banks were already planning on selling the run-up.
And this is why some IPOs feel crappy. The day or even week a company goes public, their stock price could go for quite a bumpy ride up and down as volatility soars and the market determines its value.
Since a company's first day, week, or month on the market can be pretty volatile, sometimes it's best to wait for the dust to settle before getting involved. Paysafe, a company that does $100 billion in transactions between their digital wallet, their iGaming solutions, and merchant acquirer, is projected to have $1 billion in revenue for 2021, and the share price sits just above $14 currently, meaning good companies SPAC, good companies IPO. Do your research. Due diligence is a crucial aspect of investing.
Exactly. At the end of the day, while everyone wants to get in at the ground level, you don't need to buy the stock of a company the first day they go public. And it doesn't exactly matter how a company goes public. What matters is that you do your research and don't just buy a stock because of how or when they go public.
And talking about ground level, let's get into our second story, which has a lot of ground in it.
We are going to dive into Biden's infrastructure plan, or also known as the American Jobs Plan, and give you some stocks that might benefit from its roughly $2.2 trillion budget.
The administration is investing billions of dollars into almost every part of America. We're only going to focus on some of the bigger budgets of this bill.
This infrastructure bill designates $115 billion for modernizing our roads, highways, and bridges that are all in desperate need of repair and cost the trucking industry billions of dollars a year.
Now, infrastructure has been a topic for multiple terms, from Obama to Trump to Biden, and a lot of stocks involved in infrastructure already have that priced in. We are here to give you a pure play infrastructure stock with plenty of potential.
And that's PAVE ETF, or ticker PAVE, or otherwise known as the Global X U.S. Infrastructure Development ETF, which seeks to invest in companies that stand to benefit from a potential increase in infrastructure activity in the United States, like an infrastructure bill, including those involved in the production of raw materials, heavy equipment, engineering, and construction.
Their top holding is John Deere, which is already near its 52-week high. They also own American Steel Company, Union Pacific, and American Tower Corporation. They are involved in every aspect of infrastructure you can think of. Without a set-in-stone plan, it's hard to know which stocks will benefit from Biden's infrastructure plan. But the PAVE ETF will make sure you get a slice of the pie.
And after diving into Biden's plan, we noticed that he has more invested in green energy than on our highways, roads, and bridges.
Right, this bill will invest $174 billion into electric vehicles. This includes 500,000 charging stations.
Now keep in mind that's roughly $60 billion more than we are planning to spend on our roads, highways, and bridges. So you could expect to see quite a few more Teslas and probably the same amount of potholes. Besides that fact, EV charging station companies like Blink, ChargePoint, and Volta should all benefit from these incentives. These companies will likely compete and probably split some of the government contracts to build these all over the United States. Now, Jason, hit us with a few fast facts.
As it stands today, Biden's American Jobs Plan plans to spend $111 billion for water infrastructure, $100 billion for broadband, another $100 billion for power infrastructure, and $621 billion for transportation. But these are just some of the expenses inside of the American Jobs Plan.
And that sounds like a lot of money, and it is, but America really needs some TLC, which is tender love and care. And I'm sure most of us know that the water in Flint, Michigan is just full of lead and unsafe to drink, and it's been that way for years. And unfortunately, according to Biden, there are hundreds of places just like Flint across America. So these investments are crucial, and at the end of the day, we could all agree everyone deserves access to clean, drinkable water.
Right. Since this bill still needs to work its way through Congress, there might be quite a few changes that happen before it passes, which means some of this info might change, but we're just trying to give you a heads up so you can get in on the ground level of these stocks.
Now thanks for listening, traders, and we'll catch you next week.
Don't forget to hit us up on Twitter or our new TikTok page at Best Pod Yet.
We got some polls up for you guys, so peace.
Peace.